Okay, picture this. You go out, you buy a beautiful plot of land. You order a massive pile of bricks, wood, and concrete, and you just start building. No blueprints at all, no measurements, no real plan. Would you ever build a house like that? I mean, it sounds completely crazy, right? But surprisingly, when we look at the data, this is exactly how a lot of people approach their financial futures. They just kind of jump headfirst into the stock market without a plan, crossing their fingers and hoping it all magically comes together into a dream home.
Well, welcome back to The Explainer. Today, we are diving into the fascinating way professional investors construct incredibly resilient portfolios. We're going to treat your wealth like a master architectural project, exploring the absolute basics of portfolio planning and construction. By the end of this, you're going to understand exactly how to lay a financial foundation that is so solid it can weather pretty much any market storm.
All right, let's take a quick look at our game plan for today. We're going to cover 1. The investment master plan. 2. Knowing the client. 3. Setting risk and return. 4. The 5 investment constraints. 5. Capital market expectations. And finally, 6. Strategic asset allocation.
Starting right at the top, Part 1, the investment master plan.
So we have to begin with the foundation of any successful wealth strategy, and that's the investment policy statement, or the IPS. Now I know, it sounds like the most boring, dense legal document ever, but honestly, it's the ultimate blueprint for your financial success. It explicitly writes out your investment objectives and all the highly unique constraints that apply specifically to your portfolio. Without actually getting this written down in advance, achieving your goals becomes a total guessing game. This one single document governs literally every subsequent decision made in the portfolio construction process.
Moving right along to Part 2, knowing the client.
Obviously, before an architect draws a single line on a page, they have to survey the land. In portfolio management, this happens during the planning phase. The whole process is basically planning, execution, and feedback. But right now, we are firmly planted in Step 1, planning. And this requires a seriously deep, intensive dive into gathering critical client information. We have to understand a client's specific needs, their family situation, their employment stability, and just their overall financial health. You literally cannot execute a strategy without completing this crucial fact-finding mission first.
Which brings us to Part 3, setting risk and return.
This right here is where we get to the actual foundation of the house, balancing your return objectives with your risk tolerance. And man, this is where human psychology gets really fascinating. You see, there's a massive difference between a client's psychological willingness to take a risk and their actual financial ability to endure it. Let's say you're an adrenaline junkie, right? You have a high psychological willingness to watch your portfolio bounce up and down. But if you need that money next month to pay your rent, well, your financial ability to take that risk is essentially zero. A properly crafted IPS balances what you want to do psychologically with what your finances can actually handle structurally.
Part 4, the 5 investment constraints. To establish our property lines and building codes, we have 5 incredibly rigid boundaries that every portfolio manager has to work within when drafting that IPS blueprint. They are liquidity, time horizon, tax status, legal and regulatory factors, and unique circumstances. Let's briefly break these down so we can see how they shape the actual build of the portfolio.
First up is liquidity. You can think of liquidity as the doors and windows of your house. It basically dictates how easily you can get your money out when you actually need it. If you have an unexpected massive expense coming up in, say, 6 months, you absolutely cannot have your money locked away in some illiquid asset like a private equity fund. You need assets you can quickly and painlessly convert to cash.
Next up is your time horizon, which is exactly what it sounds like, the timeline for your investment journey. A much longer time horizon, like if you're saving for a retirement that is 20 or 30 years away, allows you to safely use riskier building materials, like equities. Why? Because you have the luxury of time to recover from sudden market dips. But if your horizon is super short, your materials need to be much more conservative.
Then we've got tax status and legal constraints. Just like an architect has to navigate local zoning laws, the portfolio has to navigate the really complex realities of taxation and strict regulatory requirements. For instance, some investors are going to face a completely different tax rate on their dividend income than they do on their capital gains. So smart blueprints position investments to maximize those after-tax returns, all while operating totally within local regulations, like the specific rules governing family trusts, corporate accounts, or retirement withdrawals.
Our fifth and final constraint is unique circumstances. And what's really interesting about modern investing is how heavily it now integrates ESG considerations. That's environmental, social, and governance factors. This allows a client's own personal moral values to actively shape the portfolio, whether that's intentionally avoiding businesses tied to fossil fuels or making sure you're investing in strict alignment with your religious faith. Your personal values literally become structural constraints that guide the entire planning process.
Part 5. Capital Market Expectations.
Okay, so with the blueprint drafted, we need our raw materials, and that brings us to capital market expectations. Simply put, these are the projected risk and return prospects of various asset classes, things like stocks, bonds, or real estate. We quantify these materials by looking at their expected returns, their volatility, and how they actually move in relation to one another. It's really about knowing exactly how strong the steel is before you go and use it to frame the building.
And finally, Part 6. Strategic Asset Allocation.
Now it's time to actually frame the house. This is the exact moment the planning finally becomes reality. We take our raw materials, those long-term capital market expectations we just talked about, and we combine them with our blueprint, the investment objectives and constraints from our IPS. When we feed both of these critical pieces into optimization models, they converge to give us our final output, the strategic asset allocation.
So what is it? The Strategic Asset Allocation, or SAA, is the actual physical framing of your portfolio into permissible categories like equities, fixed income, and alternative investments. Remember, this isn't about picking individual specific stock tickers just yet. It's about deciding that your house needs exactly, say, 60% equities for growth and 40% bonds for stability. It is the overarching structure that's expected to achieve your long-term goals safely.
In practice, a real-world strategic asset allocation divides a portfolio up precisely according to that master plan. Just as a hypothetical example, you might see a heavy weighting in fixed maturities, say nearly 77%, with much smaller allocations left over for short-term investments and common equities. That specific framing perfectly reflects that specific client's risk tolerance, their time horizon, and those unique constraints we mapped out earlier. Every single percentage point serves a deliberate, structural purpose.
So, there you have it. We have gone from the totally empty lot to a fully framed portfolio, all built entirely upon the rock-solid foundation of an investment policy statement. Which really brings me to a final, kind of provocative thought I want to leave you with. What does your financial blueprint look like? Are you just blindly piling up bricks and hoping for the best, or are you actually building with a master plan? Challenge yourself today to sit down, define your true risk tolerance, map out your unique constraints, and formulate a wealth strategy that structurally works for you. Thanks for joining me on this explainer, and I'll catch you next time.